Hello, I'm Steve Stafford of the law firm of Brown & Strezzo. Thank you for joining me for this installment of our video series, All Business is Personal, a general counsel's perspective on growing, protecting, and maximizing the value of your closely held business. In the next few videos, we're going to focus on how choosing the right type of business entity can help you to both operate and to sell your business more tax efficiently. Although there are more than 3 types of entities to select from, the majority of entrepreneurs choose to form their closely held businesses as a C corporation, an S corporation, or as a limited liability company. But there are 3 factors that should always be considered when making this decision. 1, liability protection, 2, income taxes, and 3, transferability and succession planning options. So let's first look at some of the advantages and disadvantages of C corporations. Why would someone choose to form a C corporation for a closely held business when there's so much talk about S corporations and LLCs? Well, there are actually a number of reasons, such as the ability to hold investments at the current 21% tax rate instead of the higher personal rates, the need for a blocker corporation if there are shareholders such as a charity, foundation, or foreign individual that want to avoid filing a United States income tax return, to name a few. But the reason I want to highlight is the potential exclusion of capital gains from the sale of qualified small business stock that has been held for at least 5 years. This exclusion is only available to C corporations that are considered to be a qualified trade or business, which for purposes of Internal Revenue Code Section 1202 generally means businesses that are not categorized as personal services, financial services, hospitality services, farming, or real estate. Also, this capital gains exclusion is limited to the greater of $10 million or 10 times the amount of basis, and the corporation's total gross assets cannot exceed $50 million. The bottom line is that although there are some complexities and requirements to satisfy, when the right facts are in place, the potential tax savings from the qualified small business stock exclusion are tough to beat. So, what are some of the disadvantages of C corporations? The primary disadvantage of C corporations is the double tax on corporate earnings. First, the corporation itself pays federal income taxes at 21% and California state income taxes at 8.84% at the corporate level. Plus, the shareholders also pay taxes on any dividends or compensation that are paid out from the corporation. Now, there are a few ways to minimize the sting of the double tax, which I will highlight in a later video. Well, thanks for watching. Stay tuned for our next installment where I'll be discussing S corporations. And finally, as a reminder, this video is for educational and information purposes only and should not be taken as legal or tax advice. Thank you.